Welcome to today's webinar on the interim budget for FY25. As we navigate through the fiscal landscape of the nation, it is essential to stay informed and understand the intricate details of economic policies that shape our financial future. This webinar today aims to be a valuable resource in this regard. I am Sonal Mittal, Product Specialist at UTI Mutual Fund. I am joined by our esteemed speakers, Mr. Anurag Mittal, Head of Fixed Income at UTI, and Mr. Sachin Trivedi, Fund Manager and Head of Equity Research at UTI, who will share their perspectives, providing us with a well-rounded understanding of the budget and its potential impact on various sectors. Please feel free to actively engage, ask questions, and make the most of this opportunity. Without delay, I invite Mr. Sachin Trivedi to begin the discussion with his insights. Thank you, and let's have an insightful session together. Over to you, Sachin.
Sure. Thanks, Sonal, and thanks everyone for joining. So, effectively, I'll just say that maybe from activity perspective, what the FM has laid down is maybe clear priorities, right? Clear priorities in the sense of fiscal consolidation. Which is which is very much required, that fiscal prudence and the glide path which the FM has given a couple of years back. I think we are sticking to that in a sense that the deficit has been very well, actually, from the market's perspective, has been a surprise. The amount of crowding out effect, maybe the borrowing amount has also been quite reasonable compared to what market has expected, which is what I think Anurag will get into over a period of time. But from equity perspective, very quick one is that clearly no tinkering with the taxation. That's clearly very much a positive. Obviously, they will in the final budget, which is because this was an interim budget. This is just a presentation of account, and I think in June, July they will come out with the detail. But the FM has clearly laid down that they want to formulate the policy clearly from a longer term perspective, which is to make India a developed nation at some point in time, maybe 2047. And in those direction only, the priority of how they're going to spend within the limited budget, how they're going to spend, that priority is clearly laid down. So, of course, we will talk about details, but I think within the fiscal consolidation, there was very limited room for the FM, how much they can spend. But within that, the priority was clearly on, I will call it a capex or a prudent spending, rather than on probably spending on subjects like a subsidy. So that's where I think a commendable job has been done. And which is where clearly because as the economy has stabilized and moving in right direction, they're looking to pass on the baton of capex and development to the industry, and they are just entering in the areas like providing funding for R&D and other stuff is what I meant and the FM meant by working towards longer term development. Also, she made a couple of statements about directionally how they want to promote tourism and other stuff and improve the infrastructure in the country. So with this, I think let's get into the details. Sonal, you want to go? So from sectoral perspective, just before we get into the slide, I just want to say that because this was an interim budget, no material announcement, which all of you by now would have realized that there are no big bang announcements. So but what we can pick up only is a few data points, which is what gives us the confidence that we are moving in the right direction, and which is where when we look at the capex allocation. Of course, this is from the BE perspective or the budgeted estimate of 2024. For FY25, the capex is going up by almost 11%, but on a revised estimate, this capex is going up by more than 70 or just around 17%. So now this is close to 3.5%, 3.4%, which is on a if you compare the whole decadal perspective, this is a very good number. Within this, the brighter spot is defense, defense capex, and now we should, from the market perspective, we should look at as a brighter opportunity because this 9.4% and further, although budget doesn't lay down the details of it, but we all know that there are more and more indigenization is happening within the defense side, which would mean that from the domestic company's perspective, the opportunity is or the growth opportunity is much larger because effectively the import content will come down, the domestic content will go up, and domestic content is cheaper compared to imported product, which means that the volume growth for the domestic companies would be much higher. From moving to the road, the rail, I think the allocation has been quite healthy, but of course, more action, I think, because they are committed to development of a couple of projects like what they've announced for Vande Bharat. They want to improve the coaches or the bogies. Which is where in the railways they have announced clearly the intent, more about the safety, more about the aesthetic and improvement. Even on the road side, clearly the commitment, the longer term commitment is towards improving the road network, which is where there is a healthy allocation of close to 2.7 trillion. Again, like post Ram Mandir announcement or the inauguration, FM the Prime Minister has clearly laid down, I think, the solar rooftop announcement which was there. So in that direction, or even in the direction of energy security, clearly the renewable energy allocation has increased by more than 63%, which is quite a healthy allocation from the government perspective. The bigger one is again the determination to provide more housing to Indians, which is where we are going to have 2 crore homes in next 5 years, which is an allocation of almost 80,000 crore rupees. So especially this Pradhan Mantri Awas Yojana, it's a continuation of past policies, which actually is beneficially for not just the building material or cement, but even for the banking and the housing finance companies. Can we go next? Sonal, can we go next? Yeah, from auto perspective, there was this wide scale expectation that FAME 3 will be announced. But as of now, what we see as far as this budget is concerned, that they basically just the initial FAME 2, which was originally 10,000 crore, which was over a period of time got utilized, and the leftover, the balance portion of almost close to 2,600 crore will be utilized in FY25. Which means that at some point in time, government probably may or may not announce the FAME 3 or maybe some other sort of subsidy. But clearly, from the documents, we also see that there has been improved allocation towards PLI schemes, which is so FAME 2 actually goes into providing direct subsidies to the buyers, but the PLI is providing subsidy to the manufacturers to indigenize most of the components or the battery cells, and which is where we have clearly seen the allocation has gone up, and clearly the intent from the FM was also there to improve the infrastructure for EV, more adoption of EV. So which means that improving the buses, improving the infrastructure for charging, all of that. So there was a clear improvement in the allocation, and therefore the clear intention from the government perspective that they want to improve the EV infrastructure, and which is where the allocation in this budget as well has gone up towards the auto side. So which is partly positive from the auto perspective. From pharma perspective, again, like I said, continuation of the government's thought process of indigenizing more and more, which is where the production link incentive, there was an improved allocation of close to 21 billion, which is an improvement over a 17 billion allocation in a revised estimate of 24. Now, from a fertilizer perspective, again, no big bang announcement, but what you will see here is that there is a reduction in the subsidy of close to 20 or of close to 13% over revised estimate. But we have to keep in mind that the raw material prices have also gone up. So this is just adjustment for that. So from the company's perspective, there is practically no impact on the companies because this is just a raw material adjustment which is happening in the budget. Can we go next? Again, oil and gas, I think there was this OMCs. So if you recollect last year in the budget, there was some allocation of close to 30,000 odd crore, which was done towards promoting investments in oil marketing companies so that they can go towards improving their infrastructure or improving their machinery and adopting more towards cleaner fuel. However, that has been brought to nil in revised estimate, and for next year, this has been posted at 15,000 crore. But remember, from the company's perspective, I think government in last 1 year has not actually or the companies have made actually healthy recoveries because the refining margin for these oil marketing companies have been healthy. They have been last year they were running negative margins on selling oil, which is the petrol and diesel. This year they are turning positive. Their balance sheets have turned healthy. So now they themselves have sufficient cash flows, and if there is if they continue with the current pricing, the cash flows and the balance sheet of these companies will be healthy, so they themselves can take care of these investments. So there is no need for government to provide more subsidies or direct intervention on the capital support to this, and which is where it's in the right direction. So again, no impact. As far as FMCG is concerned, of course, this sector doesn't need a lot of help from government, but I think from company perspective, cigarette, no incremental tax itself is a good announcement as far as cigarette companies are concerned, and which is where there was clearly no announcement, and which is what is positive for the sector. I think there has been of late, we have seen some bit of slowdown in rural consumption because of inflation. I think clearly there the Manrega outlay is has been kept at around 86,000 crore, which is again a positive news as far as sector is concerned. Can we go next? Sonal? Yeah, I think that's it. That sums up. So I'll say not much tinkering from market perspective. I think continuation of the existing policy is a good news, and which is what at least what we have seen. The intention of the government is very clear. Only intervene if there is urgency of need, and otherwise, I think let industry respond to the market development. So I think it's in the right direction. And I'm sure Anurag is going to speak about it, but I think the fiscal prudence is the utmost requirement, and which is what they have actually continued. So with this, I will stop here and maybe hand over to Anurag.
Sure. Thanks, Sachin. So I'll request Sonal to put up the presentation, just detailing the major. Yes, thanks. So broadly, good morning, everyone, and thanks for joining in on our budget webcast. So broadly, the expectation from the interim budget was very muted, given that there is an election and the final budget will probably be presented in June and July, somewhere thereabout. So the broad expectation from the bond market was that one, probably it should not be very populist, given that's a politically active year. The second was it should show a commitment and continuity towards fiscal consolidation because the government had committed to a 4.5% fiscal deficit by FY26. It becomes even more important because states are now facing slightly higher fiscal issues compared to what they were facing pre-pandemic. So the overall government debt to GDP and overall government fiscal deficit uh, needed a continuity towards consolidation. And third was the market's expectation on the borrowing number and the kind of funding that government will be doing through a mix of small savings, treasury bills, and dated borrowings. So if you look at all the three parameters, the government has outperformed consensus expectations. So typically, market participants were expecting a fiscal deficit somewhere of 5.3, 5.4%, because the GDP base itself, which the government was facing this year, had gone a downward revision because of lower, uh, wholesale price inflation. If you look at where the government started in FY24, it was expecting a 10.9% growth in nominal GDP compared to the actual or the first advanced estimate, which has come at 8.9%. So the nominal GDP base had shrunk slightly. So compared to that, for a 5.3, 5.4% fiscal deficit number, government has come up with a 5.1% fiscal, number. And uh, you know, on the gross borrowing side as well, government has outperformed most of the expectations. So broadly, and I will just take us through the details. So broadly, if you look at where how things stack up, so typically tax collections are a function of nominal GDP growth, which is basically called tax buoyancy, which is your function of how much growth in GDP can lead to a growth in tax collection. So if you see, despite possible nominal GDP growth of 8.9%, the corporation tax growth for FY24 RE was over FY23 actuals was 11.7%. If you look at income tax, it's been very, very stable, around 22.7. Customs, of course, has again been stable. And if you look at GST as well, that's also largely tracking, a decent multiplier over nominal GDP compared to its previous run rate. For FY24 RE, if we see the compared to the budgeted dividend and profit of 90,000 crores, government got a higher dividend profit of 1,54,000, mainly due to higher dividend from RBI and PSU banks. And the other non-tax revenues were largely in line with the budgeted estimate. Of course, there was a slight disappointment in terms of disinvestment, which was 30,000 compared to the budgeted estimate of 61,000. But that was largely offset by lower spending on capex. So against the capex spending of about 10 lakh crores, government ended up doing capex of somewhere about 9,50,000 crores, which I will detail in the next slide. But coming and looking at the revenue, so if you look at the revenue slide for FY25 budgeted estimate, despite a much stronger nominal GDP expected of 10.5% in FY25, government has just assumed a 13% growth in corporation tax as well as a 13% growth in income tax. So the revenue buoyancy they are assuming in income tax is reducing meaningfully for FY25, which gives them a certain cushion in case there is a slightly moderate collection from corporate tax. If you look at excise, not much difference again, even below the run rate of nominal GDP. GST, if you look, even GST, government has assumed a lower run rate in FY25 over FY24, which again gives them a cushion that even if the growth is slightly weaker than expected. If you look at dividend and profit, again, the 1,50,000 assumes similar run rate to last year, which we think is possible given that RBI will have some reasonable profits this year as well because of FX operations. And given the profitability of PSU banks and other PSU entities, we think this dividend number should be achievable. In the non-tax revenue, the growth is largely coming because of higher non-tax or equity, I would say non-cash revenue from BSNL. So the government every year infuses a certain grant to BSNL, which the BSNL pays to the government via spectrum fee. So that's largely the accounting for the other non-tax revenue. The disinvestment receipt has been muted around 50,000, so which should be broadly doable post the new government coming in. So if you look at tax to GDP, government has assumed a very moderate indirect tax to GDP, and this direct tax to GDP, which is just assumed 6.7% compared to 6.6% for FY24 RE, should be largely doable given that nominal GDP is supposed to pick up. So while the real GDP should be broadly remaining the same, it's the growth in the multiplier, or sorry, the growth in the deflator due to higher wholesale price inflation, which should lead to higher tax collections. Moving on to the expenditure part. So if you look at the expenditure, government again has assumed a lower growth in FY25 of 6.1% on total expenditure of 47.6 lakh crores compared to 44.9 lakh crores for FY24 RE. If you look at the savings, which are largely coming in, it's one, subsidy has been reduced lower due to lower subsidies on fertilizer, which is also logical given that global slowdown in fertilizer prices. The subsidy for next year should be lower. If you look at the capex, which is budgeted, it has seen a reasonable jump as compared to as a percentage of GDP. So if you look at FY24 RE, which was 9.5 lakh crores and 3.2% of GDP, despite having a higher possible GDP next year, government has maintained a 11.1 lakh crores of on-balance sheet capex. But if you look at the effective capex, which is basically the sum total of the budgeted capex plus the capex which is being planned by public sector entities, as a percentage of GDP, it's slightly lower compared to the pre-COVID period, or if you look at the pre-COVID FY17 to FY20, it was close to 4.7%. So it is 4.4% if you look at the total effective capex, which we think is more realistic because there is a limit to the absorptive capacity of the economy towards capex. So this capex is much more realistic and should not be seeing major revision when we look at the next year budget probably. And if you look at the subsidies also as a percentage of expenditure, that is also showing a very encouraging trend. So broadly, if you look at the nature of the expenditure, it is imparting a meaningful growth impulse while maintaining a slightly, I would say, lesser focus on inflationary expenditures, which is largely your revenue expenditure and your subsidies. So from a fixed income and overall macroeconomic, if I were to say stability, this budget is very positive because it overall works towards enhancing long-term productivity of the economy without imparting meaningful inflationary impulse to the economy. Moving on to the next slide, please. And this is where, if the financing of fiscal deficit, which was very well received by the bond market. So if you look at the net borrowing, which came at around 11.7 lakh 5 lakh crores, which is again approximately about 70% of fiscal deficit. It is largely in line with what's been the course post the COVID period. But the most importantly, if you look at the gross borrowing, which came at 14.13 lakh crores, it is basically lower by market estimate by around 1.2 lakh crores, because the consensus market forecast was somewhere close to 15.2 lakh crores. So what's really happened and why this gross borrowing has come lower than market expectation is that government had collected a certain compensation cess to account for the higher borrowings, which it did during the COVID period to compensate the states for lower GST collections. So government had about 1.2 lakh crores lying in its compensation cess account. So what government has done very pragmatically is that it has adjusted the maturities coming up next year with the compensation cess. So anyways, that compensation cess would have been used in the future. So the government has preempted it and used it to extinguish the maturities against which hence the gross borrowing is lower than market expectations. So if you recall, probably this year, anyways, the demand supply dynamics for the bond market was looking favorable because of the expected 25 billion odd dollar inflows, which would have come in the Indian government bond market because of the JP Morgan bond index inclusion. So, given that now government is anyways borrowing about 1 lakh crores lower in terms of gross, so that probably even further tilts the demand supply balance more constructively, and hence from a, if you look at the term structure of the bond market, it is more positive for the belly of the curve, because largely it is leading to lower supply from the government, and overall then market participants should be happier to take a slightly higher duration. Because, and why gross borrowing is more, in fact, more important than net borrowing, because typically what happens in case of if you're having a 6 months to a 1 year government bond maturing, but you are getting a much higher duration bond, so typically in terms of net duration, one should always look at gross dated borrowing, and that's where I think government has done a really commendable job, and reduced that uh, from the compensation cess, thereby broadly further helping the demand supply balance. So broadly, the term premium that one would associate in terms of monetary easing and at a stable framework of 70-75 basis, that term premium can sustain for a longer period of time, thus boding well for long-term market stability. So if you look at the overall macro construct, and overall just now moving away from the budget and what it means for fixed income investors, so overall the global macro construct has been turning positive for fixed income. So if you look at the impact of the all the monetary tightening which has happened since 2022 onwards, now the concurrent indicators of growth across the world have been turning slower. Inflation is now slowly moving towards the target, while the last mile inflationary pressures remain, but broadly inflation is moving towards that central bank's target level, thus creating space for most of the global central banks, including RBI, to cut interest rates as we move into the calendar year 2024. So probably from the fiscal side, if you see, in many economies, still they are running slightly higher fiscal than probably bond market would have liked that, and including the US. But if you look at India now, not only the inflationary pressures are slowing down, the current account balance is now moderating. Even the fiscal deficit that people were thinking would have a slightly longer term consolidation will probably get consolidated by FY26. So both from fiscal current account as well as from inflation, Indian macroeconomic backdrop is looking quite constructive. If you look at the valuations for fixed income, with valuations of 2-3 year AAA bonds, even the PSU bonds at around 770 to 780, and the 10-year bond now at 7705, it looks quite attractive from investors who are looking to invest from a 1-2 year time horizon, given it gives them a decent accrual as well as gives them an opportunity to participate in capital gains as the interest rate cycle turns. Even if for the investors who are looking to invest from a 6 to 12 months perspective, the current macroeconomic backdrop as well as valuations are quite attractive. So if you look at in the last 3-4 months, the money market curve has corrected meaningfully from like 1 year banking CDs, which were trading around 7.5, 760 in Q3 of FY24, are now trading somewhere between 785 to 790. So typically these levels should correct and they should go down as liquidity improves in the next financial year, as well as when RBI embarks upon its monetary easing cycle. Also, then providing some mark-to-market gains as well as a reasonable accrual in the year ahead. So overall, we think one of the major uncertainty for the bond market was the budget. The bond market was fearing that possibly because of elections, the budget could be more welfare oriented, leading to higher market borrowing as well as probably leading to slightly higher inflation. Both those fears have been now laid to rest. So both from a global as well as domestic macroeconomic backdrop, things are looking more constructive for fixed income. So that was it from my side. Happy to take up questions if any. Thanks.
Thank you, Sachin and Anurag, for sharing the insights and analysis and shedding light on the crucial aspects of interim budget in this election year and its implications. The webinar is now open for Q&A, and I invite the participants to share the questions in the link provided and make this Q&A session as engaging and informative as possible. While I wait for the questions to queue up, let me begin with the questions that we have already received. So the first question goes to you, Anurag. The capex has been growing at approximately 30% CAGR year on year, while in this interim budget, it has been reduced to 11%. So your views over here.
Yeah, so thanks, Sonal, for the question. So if you look at the on-balance sheet capex as a percentage of GDP, it's still growing at 3.4% in budgeted FY25 compared to 3.2% in FY24 RE. So as a percentage of GDP, it's still an incremental improvement compared to last year. And I think we also need to look at the absorptive capacity of the economy to undertake so much capex, because typically any capex like a road, airport, railways involve land acquisition, getting all the environmental approvals, getting all the legal approvals, and getting things started. So typically it takes some time to get capex cycle ongoing. So we think this capex, which government has projected, if you include even the PSU capex, is much more realistic, because typically what we have seen in the past is there are very strong targets of capex, but ultimately at the end of the year, to meet certain fiscal deficits, they get revised downwards. But if you look at the capex trend in the last 2-3 years, they have been, one, very realistic and pragmatic, and secondly, they have been largely met despite the typical time undertaken in undertaking such large capex projects. So we think that this may not be subject to major downward revisions when we look at the revised estimate in FY25.
Sure. The next question is to you, Sachin. The capex push in interim budget focusing on the private capex weaker than expected. What do you think on the roadmap for corporate earnings sustenance on this backdrop? Sachin, you are on mute.
So, yeah, I think I'm sure Anurag will agree with me. I think the one big leg of growth in the entire economy was this push by the government on the capex side. And like Anurag said, the overall percentage to GDP of the capex is still moving upward, which is 3.4%. Right. I'll come to the GDP part of it, but I think one big change from the government side that we have now obviously seen is actually rather than announcing the project and rather than actually maybe keeping the project at like what Anurag is also saying, that under work in progress, what we have clearly seen is the project completion and better execution is where the thrust of this government has been through better monitoring or the way they execute it. I think that's what is timely completion of the projects, not just save the cost, cost, but actually that improves the effectiveness of the overall objective of the infrastructure as well. So I think that's one thing we should clearly keep in mind and appreciate. I think that's one thing which is clearly going in favor of not just the government, but in favor of economy and in favor of companies as well. Because more you delay, there are losses which the companies also have to incur in form of higher work in progress, higher working capital requirement, and legal issues as well. So that's clearly in favor of the companies. Now, coming to the point of earnings outlook, I think this year, obviously, because of various factors, for companies, the top line growth has been a challenge, which was clearly below estimate, but clearly moderate or falling commodity prices have helped the operating margin of the companies. And that's where we have seen some bit of buoyancy in the corporate earning as well. Now, going to next year, I think there will still be some level of tailwind, not a lot as far as the margins are concerned. It will be clearly how the companies execute. So it will be, let's say, nominal GDP plus minus certain percentage for the organized players, clearly, because we have to keep in mind that these larger corporates, organized players, are still gaining market share from maybe that unorganized part of the economy. So I think that should clearly continue to play out. But I'll just re-clarify that unless the commodities fall sharply, I don't think we will continue to have the buoyancy of the operating margin improvement.
Sure. Thanks, Sachin. The next question is to you, Anurag. The government has backed non-tax revenues at rupees 4 trillion for FY25 budgeted estimates, which was 3.8 trillion in FY24 revised estimates. Do you see any downside to this incremental target, especially when license fee or spectrum charges from telecom sector is on the path of consolidation?
So we think that these numbers are realistic because one, like I said, the dividend from PSUs as well as RBI is expected to remain healthy given that they are seeing improvement in profitability. RBI should also see reasonable profitability because of the FX operations that they have been undertaking in the previous year. As far as the other part which you talked about, telecom, so like I said, that one part of the non-tax revenue also includes the receipts from BSNL, which basically government gives to BSNL as a grant, and BSNL then gives that as a spectrum fee back to the government. So since there is a visibility of that grant and there's a certain timeline, we don't think that the collection of non-tax revenue should be a problem for the government.
Sure. So the next question is to you only, Anurag. The global inflation environment has been on a steady decline, although inflation is still somewhat above developed markets, central banks' targets. However, given large global uncertainties, risk to the inflation remains. Do you expect the rate cut cycle to start in second half of FY25?
Right. So we think, and just like when the rates hiking cycle started in 2022, the bond market and the investors were not looking at the timing of rate hikes, right? Like nobody cared whether the Fed will hike in June or August or September, or same with RBI. What the bond market was concerned when the rate hike cycle started was what will be the terminal rate. So just to give you an example, when the rate hike cycle started in India in 2022, the 10-year made the rate cycle high of 7.62 in June 2022. RBI has undertaken most of the rate hikes post June 2022. So it's not the timing of rate hikes which matters, it's market participants' view of the magnitude of rate hikes or rate cuts, which matters a terminal rate. So if you look at let's say global markets, to start with global markets, while it is true that rates or inflation is not reaching central bank's target of 2% for most of the economies, the fact of the matter is that inflation has reached close to 2 from 9 and 10% levels that we saw in the late 2022. And if you look at their policy rates, they are well above the typical real rates that we have seen for these economies in the last 15, 20 years, which gives a very reasonable space of central banks to cut anywhere between 100 to 150 basis points in this calendar year itself. So, to us, we think it's very futile to discuss the timing of rate cuts, whether the Fed will cut in March or May or June. What matters is at the end of December 24, where do we see the terminal rates by most of the global central banks? We think they could be at least 100 to 150 basis lower in this year. There will always be uncertainty on both sides, or inflation or growth. So, but if you look at the probability, and if you look at the sum total of the probability, whether the sum total of probability to points out towards disinflation or further higher inflation, I would say the sum total of probability points towards a lower inflation. Coming to the same view for India as well. If you look at the core inflation, it has now been stabilizing at 4% for a long time. Of course, we saw higher food inflation due to unseasonal rains, El Nino last year. Probably this year, if the monsoon is normal and global food prices also remain stable, just on the base effect itself, we should see inflation moving close to 4%, if not at 4%, which should again give space to RBI to cut interest rates in the second half of this calendar year, once they have a more clarity and certainty on food inflation front. But again, the same goes for global central banks, the same goes for us. It's a terminal rate which matters for us as investors, not really just the timing of the rate. And especially given the valuations, it's not that the carry cost is punitive for investors. So if you look at, like we discussed, for let's say corporate bonds which are trading at 770, 780, even if someone has to wait it out in the near term because of the uncertainty, they are earning a reasonable carry over inflation. So whether you look at money market curve as well, with 1 year CDs trading at 780, 790, you are earning a reasonable carry over, let's say, current and even forward-looking inflation, and even compared to traditional fixed income instruments. So I think that's changed, compared to COVID. In COVID, because of the exceptionally low rates, cash was at 4.5. Today, and even 2-3 year papers were trading at 6%. Today, those papers are trading much higher. So, one, the cost of carry is quite meaningful. So one should not lose the cost of carry. Secondly, one should not speculate on timings of rate cuts, but focus on the magnitude. Thanks.
Sure. Thanks, Anurag. So the next question is to you, Sachin. In current scenario, do you expect there can be more positives in the second half of FY25? And as of now, what kind of funds would you suggest for the investors? Any specific sectoral or thematic funds? Or will it be better for investors to select schemes, funds like Balanced Advantage, Dynamic Asset Allocation, or Multi-Assets?
Yeah, I think, look, markets last year has been phenomenal returns, especially for the mid cap and the small cap side of it. When you look at from a longer term valuation perspective, clearly these indices, and I'll not pick up the stocks, but these indices are looking lot more expensive on the longer term valuation chart, right? Maybe you can call it large cap is still in an acceptable zone. but clearly mid cap and small caps have gone in a lot more expensive zone. I think that's where the investor should look to take out some money and maybe move towards a product like balance advantage fund, or maybe a multi-asset kind of a fund, which offers you potentially offers you a reasonable return kind of an perspective. Look, I think it's very important to have the asset allocation in mind, because maybe the last year's gains that maybe investors have already booked, or they have got it. Some of it is actually see in long term. I think your return is actually outcome of at what point in time you invest, and how long you stay invested in, right? But if your valuation at this point in time, especially in mid cap and small cap, is not right, I think there may be chances of you actually realizing potentially a lower return. So I think that's where the caution will be. Like Anurag has already said that maybe if there is a rate cut cycle possible, maybe that market also can give a reasonable return, potentially a reasonable return. So I think investors need to correct the asset allocation, move more towards large cap, move more towards balance advantage kind of a category, and maybe part of the money towards fixed income. That's my advice would be.
Thanks, Sachin. Anurag, my next question is to you. So during your speech, you mentioned that looking at net borrowing numbers is more important than gross borrowings. Can you please elaborate on this?
Sorry, I was trying to say that looking at gross borrowing is more important than looking at net borrowing. So thanks for asking, because I'll clarify that. So what I was trying to say is that typically when you have a maturity of a government bond in the near term, typically it's just, let's say, a 6 months or a 1 year bond, because if we look at just FY25, and if you're getting a higher duration bond, let's say 5 or 10 or 15 or 30-year bond, typically you're adding reasonable interest rate risk as an investor. I mean, anyone who's holding those bonds. So typically market participants also look at gross borrowing number than just net borrowing, because in case the net borrowing would have been lower, but the gross borrowing would have been around, say, let's say 15 lakh crores. That means at a gross duration level, one still has to absorb a higher number. But in this case, what's happened is, while the net borrowing is largely flat compared to FY24 RE, the gross borrowing number is about lower by 1 to 1.2 lakh crores for FY25 BE. And hence, we think it's market participants have taken it more constructively, because at a gross level, that means they have to take lower duration.
Sure. Thanks, Anurag. My next question is to you, Sachin. What's your take on EV sector as PLI scheme for advanced chemistry cell battery storage allocation at rupees 2.5 billion against rupees 120 million in FY24, and its impact on earnings?
Sure, I think intent of the government is very clear, is to promote more and more indigenization of not just the battery cell, but also to improve the infrastructure and encourage companies to actually start producing or introducing more and more models, so that the adoption of overall EV sectors improve in the country. Remember, from government's perspective, I think the overall point is not to completely move towards EV. We have to be a lot more practical about it. They at the same time, they are also promoting a lot of gas station, which is the CNG station. So I think their approach is more towards a balance approach, and which is where the newer technologies like EV, the whole approach of creating the ecosystem around it is what they're promoting. Now, of course, there are newer players. The competition is quite intense, which is a usual case in any new offering, which is where you see a lot of players actually entering in the market. But it is also very clearly seen that the existing players responding well, not just in creating ecosystem, but also introducing newer products. And which is where we've seen, let's say, in PV, we have seen that the let's say one domestic player itself is holding a large market share. In two-wheelers, we have seen two-wheelers, three-wheelers across the board. Existing players have started to respond, introduce new products, and started clearly inching up the market share in these spaces. But clearly, the intent of the government is to encourage players to not just improve the manufacturing capacity, introduce new products, but at the same time ensure that the sufficient charging infrastructure is in place, which is where there has been allocation and comments by the FM. And finally, create the ecosystem around, let's say, the battery cell and the related technologies, which ensures that we have homegrown product and the adoption improves. Basically, essentially, all these efforts is to improve infrastructure, lower the pricing for end consumer, and therefore improve the adoption. I think we are going in the right direction. Clearly, the sense is that the buses, the three-wheelers, the two-wheelers will see faster adoption. I think the four-wheeler will take some time before the adoption improves.
Sure. Thanks, Sachin. One more question to you. Incentives budgeted under various PLI schemes are starting to gain around. In FY25 budgeted estimate, the incentives, including on semiconductor and related segments, at rupees 211 billion are estimated to double from FY24 revised estimates dispersal. So, who are the key beneficiaries of these schemes?
See, I think there are names already. I can't be company specific here, but obviously there are companies which have applied either through the listed name or through group companies. But remember, these are linked to how much. So there are revenue targets which the companies are supposed to meet. On those revenue target is this the incentive. Let's say in two-wheelers, anywhere between 12 to 16% incentive will be provided. But the end objective of neither the company or the government is not to hold back these incentives, right? The end objective of the players and the government is to pass on to the end consumer or in the system so that the cost goes down and therefore adoption improves. So it is not just the semiconductor or not just the EV, but even in the places like AC manufacturing and whole host of the, other places, you will see that the capacities are coming up, and therefore effectively the end price of the products will go down, which will give thrust to the volume, or which will improve the volume in the system. And this is how you will see the top line growth for the companies. Effectively, I'm not saying that this will result in any significant improvement in the margin, but certainly thrust to the top line of the company. So we have to be watchful across the player. I think these names are very much published. Maybe can do a simple Google search. I can't be name specific here, but you will find in specific areas there are the players who have done it. But remember, keep in mind, this is not to improve the profitability. This is to pass on to the consumer. Companies benefit through improvement in the volume.
Yeah, thanks, Sachin. In the interest of time, I'll take one more question. That's to you, Anurag. How do you see yields in the fixed income markets panning out over tenures of 1 to 2 years for various classes of instruments, including GSEC, CD, CP, NCDs? And
Right.
also, the next question along with this is, which schemes or strategies do you suggest for the investors? And would you suggest any tactical allocation?
Right. So we never ever advise tactical allocation. So, and we think that investors should keep their investment horizon and risk appetite in mind to take any call. We are just expressing our view, and of course, it's ultimately investors who have to, understand the risk and invest accordingly. As far as the what segments are looking attractive and what could be the possible, valuations that we see in them. So I think in the next 1 year, probably assuming a 50 to 75 basis rate cut from RBI and assuming a 80 to 100 basis term spread uh, of 10-year bond yield compared to the repo rate, possibly we are looking at a 10-year consolidating somewhere between 680 to 7% in the near term. Of course, as you go along, what also matters for the term spread or for longer term government bond valuations is the supply, tax collections, next year, and possible again demand supply dynamics. So possibly in the near term, these term spreads can further compress, but because of some FPI related flows or global pivot. But largely from a long term trend basis, this is the term spread which largely plays out and has played out across various time periods. Uh, in terms of typical CD CP spread that we see uh, on a normal neutral liquidity level, uh, we should see 80 to 100 basis again term spread, which can compress in the near term, but largely on a steady state basis. That's the spread typically we have seen compared to the overnight rate. So assuming a 6% repo rate, again, one can visualize that kind of a spread over 1 year CD. Now coming to the recommendations for various time horizons. So given that an investor who's looking at a 6 to 12-month allocation, typically their volatile, their appetite for volatility is slightly moderate, and hence we recommend them allocation to money market or low duration funds, which are also sitting at very reasonable carries, as well as they are providing some opportunity to participate in capital gains as the rates come off. For investors who are looking at 1 to 2 year, so while yes, in the near term, government bonds can outperform corporate bonds or STLs because of higher supply. Again, from a steady state perspective, if an investor is looking at a 1 to 2 year allocation, probably investors are better off investing in intermediate or moderate duration categories such as short term fund or corporate bond fund, etc. Because one, it is giving them reasonable starting valuation today. Plus, it gives them opportunity to participate in capital gains as well as the rate cycle turns. So, like we said, uh, for India, probably the view is 50-75. Globally, the view for rate cuts is probably close to 150 basis points. So, compared to global interest rate cycle, the Indian interest rate cycle is likely to be shallower. One, because we do not have a growth problem compared to the rest of the world. Secondly, we did not hike very aggressively compared to rest of the world. If you look at, for example, the US has hiked in excess of 500 basis points in this monetary policy cycle. So of course, when they cut also the cuts could be higher in terms of magnitude as well as order. For India, it could be more moderate, and hence moderate duration is much more advisable for investors, as it could be lesser volatile in the more medium to long term.
Thank you, Anurag. At this time, I would like to thank you all for being part of today's webinar on the interim budget for FY25. Your active participation and thoughtful questions made this session quite engaging. Please share your feedback on the link provided. Special thanks to our speakers, Mr. Sachin Trivedi and Mr. Anurag Mittal, for their valuable insights. As we conclude, we encourage you to stay connected with us for future events and updates. Your interest and involvement make our webinars successful. Have a great day ahead. Thank you.
Thank you, Sonal. Thank you, everyone.
Thank you, everyone. Thank you. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.